Rule 506B offers businesses a powerful way to raise capital without the burden of SEC registration. This exemption under Regulation D has become a cornerstone of private capital raising in the United States, allowing companies to secure unlimited funding while following specific investor guidelines. At its core, Rule 506B provides an exemption from securities registration requirements for companies raising capital. Under this rule, issuers can raise an unlimited amount of money without registering their securities with the SEC, provided they follow certain restrictions on who can invest and how the offering is marketed. The most distinctive feature of Rule 506B is its investor limitations. Companies can sell securities to an unlimited number of accredited investors, individuals with high net worth or income, plus up to 35 non-accredited investors who meet sophistication requirements. These sophisticated investors must have sufficient knowledge and experience in financial matters to evaluate the risks and merits of the investment. A critical restriction under Rule 506B is the prohibition on general solicitation or advertising. Companies cannot publicly promote their offering through websites, social media, or mass communications. This stands in stark contrast to Rule 506C, which does permit general solicitation, but restricts participation exclusively to accredited investors. Investor verification represents another key difference between these exemptions. Under Rule 506B, issuers can rely on a reasonable belief standard when determining if investors are accredited, typically using questionnaires. Rule 506C demands much stricter verification procedures, requiring documented proof of accredited status. The advantages of Rule 506B are significant. By allowing participation from sophisticated non-accredited investors, companies can access a broader investor pool. The less stringent verification requirements also streamline the investment process compared to Rule 506C offerings, potentially making it more attractive to certain investors who value privacy. Despite these benefits, Rule 506B comes with important compliance considerations. Companies must be careful to maintain pre-existing relationships with potential investors, rather than soliciting new ones through advertising. They must also ensure that any non-accredited investors truly meet the sophistication requirements. After the first securities sale, issuers must file Form D with the SEC. This document contains basic information about the company, including names and addresses of owners and stock promoters. While this filing doesn't require extensive disclosure, it must be completed within 15 days of the initial sale. State regulations still apply to Rule 506B offerings. Although the rule preempts most state securities laws, issuers must submit notice filings in each state where investors reside. These requirements vary by state, making it important to understand the specific regulations in relevant jurisdictions. For investors, securities purchased under Rule 506B are considered restricted, meaning they cannot be freely resold. Typically, these securities must be held for at least 1 year before resale, unless an exemption applies. This limited liquidity is an important consideration for anyone participating in these private offerings. Potential investors should conduct thorough due diligence before committing funds to a Rule 506B offering. Verifying that the company has filed Form D with the SEC and contacting state securities regulators for information about the company can provide valuable insights. Investors should also understand that these private investments typically involve higher risk and less transparency than public offerings. When comparing Rule 506B to other exemptions like Regulation A+ or Regulation Crowdfunding, the key differences involve investor qualifications, solicitation rules, and disclosure requirements. Each exemption serves different capital raising needs, with Rule 506B particularly suited for companies with established investor networks seeking significant capital without public advertising. Rule 506B continues to be a vital tool for private capital formation in the United States. By balancing investor access with appropriate protections, it allows companies to raise substantial funding while maintaining the private nature of their business. For both issuers and investors, understanding the specific requirements and limitations of this exemption is essential for successful participation in private securities offerings.